I'm Jenny Brown. Welcome to this week's MFB news. How are you all? Hope you're good. Still cold, still wet. It just feels like it's rained forever, doesn't it? But not long to go. January is nearly done, thank goodness. February is a short moon walk, and then we're into spring. So the end is nigh, guys. We are nearly there. Now, in terms of what we've got for you this week, we're going to do our usual update on swap rates, mortgage pricing changes. Then we're going to share some interesting data. I've just been reading lots and lots of reports lately with regards to the housing market and the rental sector and the broader economy. And there's a few bits of kind of data in there that I just found really, really interesting that I want to share with you. And then finally, we're just going to have a quick chat about how you finance a semi-commercial property. Okay, so swap rates, first of all, I'm just going to say it. 5-year swaps are currently at 3.95%. Now, this is when I should probably end the video, stop talking, not jinx anything, and, you know, leave things open for a better week next week again, because well, I don't want to jinx things, but actually I'm not going to stop talking. I'm going to give you some comparisons. So 5-year swap rates last night are under 4%. This is fantastic news. You know that under 4% was something that I've been sort of banging on about for a long time. Obviously, we'd like them to be under 3%. I mean, under 2% would be even nicer. But the reality is that we were under 4% for quite a long time. We then ticked back over again, which was really frustrating. So to be below 4% is a bit of a hallelujah moment as far as I am concerned, given the current climate. Now, in terms of year on year, actually 5-year swaps are circa 0.2% higher than they were a year ago. So we haven't really kind of made up the loss that we've made. But actually still to be below 4%, like I say, is a really good thing. 2-year swaps are 4.09%, 1 year ago 4.2%. So actually, interestingly, year on year 2-year swaps are actually performing better. And what's really interesting is if you look at the performance of 2 and 5-year swaps kind of over the last couple of years, 2-year swaps have been, broadly speaking, around 0.5%, 0.4%, 0.5% higher than 5-year swaps. That's why 2-year fixed rates have been more expensive, but the gap is really closing. And when we keep in mind that 2-year swaps are at 4.09%, 5 years at 3.95%, actually we're talking like 0.02% difference or something. It's tiny. So this is really implying to me that actually the way the capital markets are pricing in base rate reductions in the future is telling me that they think we're going to have over the next 2 years a round of base rate reductions, which we've been talking about for ages, and then actually things are going to stay much more static over the 5-year period. So essentially reaching a kind of new normal of base rate. Let's wait and see. Now, in terms of how this is working in terms of lender pricing, actually a lot of lenders I think are kind of just like taking their time to respond to the change in pricing, not because they're mean, but because actually to reprice a whole set of mortgages. And don't forget that a lot of these lenders, we're not just doing buy-to-lets, they're also doing homeowner mortgages as well. So these product sets, some of the lenders have like hundreds of products. So to reprice a whole set is actually a really massive task. So I think some lenders are actually just kind of sitting and waiting to just kind of let the dust really, really settle. Let Trump come into power, you know, that's happened now. Let's see what he's got to say for himself and what feathers he's going to ruffle. So let things settle down a little bit. So I think actually in terms of lender pricing, we haven't seen much movement in the last week. I'm just having a look through what I've got for you. Yeah, it's very, very small. So I think actually we might see some changes over the next few days. But actually I think no one's going to be rushing to make changes just in case it all goes wonky again. So I think it's good news. We're kind of partway through the woods, but there's actually no guarantee we're not going to go back into the woods again in terms of swap rates. Now, lender pricing. So interestingly, what we have seen is actually a couple of fairly sizable specialist lenders, so Aldermore and Paragon, not change their whole product set, but just bring out some limited edition rates. So what they're saying is, here's our normal products, these haven't changed, but actually we've got a couple of sort of like gems in here, which are only available for a limited period of time. We're not going to tell you how long they're available for, or what the kind of parameters are around the availability. We're just leaving these on the table for a period of time, and we can pull them at any moment without disrupting our whole product range. And this is a really kind of neat way of being able to bring out some more competitive rates given your lower cost of funds, but not making it an absolute kind of nightmare if you need to reprice things. So what have we got? So Aldermore have now brought out some 2-year fixed rates from 4.79%, and they're available to 75% loan to value. 4.69 if you've got an EPC rating of A to C. And their multi-unit property offering, so this is where you have one mortgage secured against multiple properties, 2-year fixes from 4.74% there. Now, Aldermore, wonderful lender, very much a specialist lender, so they can do your kind of vanilla stuff. You can get cheaper rates if you're kind of really falling in the vanilla category, so you wouldn't necessarily go to them. But these guys really excel at HMOs, multi-units, limited companies, trading limited companies, layered companies, landlords with larger portfolios, that kind of stuff. So really, really good from Aldermore there. And I just want to point out, they're very quick to say in their blurb that sits around their announcement about their rates, they can also do incorporations. Incorporations are going through another phase of popularity at the moment, I guess, where we saw interest rates really kind of tick up a couple of years ago. Landlords have been paying those historically very low interest rates, have been scratching their head about what to do. They're going through a kind of period of time running as a formal partnership, and now they're kind of ready to incorporate. So we're kind of getting to that stage of the process. We are seeing a notable uptick in incorporation inquiries. If you have one, talk to us. We're very good at these. We've done absolutely loads of them. They're kind of, someone say easy, but they're second nature to us. Not every broker does many of these, and you can go wrong with them. So it is important to get some good advice. The other lender, like I mentioned, was Paragon, who have brought out some new limited edition 5-year fixed rates. So rates from 5.14% for a standard property and from 5.39% for HMOs and multi-units. Paragon are very good at HMOs and multi-units. They can do up to 20 self-contained flats or 20 rooms in an HMO. So some really lumpy properties again. Specialist lender, so no maximum number of properties in the background. They can do limited companies, layered limited companies. You have to be an SPV for Paragon, unlike Aldermore, who can also do trading companies. Now, more broadly than that, the only other kind of notable things is that we've seen Capital Home Loans reduce their rates by 0.3%, and then we've seen BM Solutions increase their rates by 0.3%. Now, BM is a bit of an outlier here. I think with BM Solutions, they've been sourcing incredibly well. So their rates were coming up top all the time over the last few weeks. I think with them, they've just got a bit too busy, a bit too flooded with business. They've realised they're kind of super cheap compared to the rest of the market. So they've ticked their rates up a bit just to kind of slow things down and also kind of bring themselves in line with the market. So there you go. That's your lender pricing change for the last week. Like I say, I suspect because swap rates have come down, and, you know, dear God, please let that continue. We will see more rates coming down over the next couple of weeks. I don't expect it to be suddenly the tsunami of lenders repricing downwards in the way that we see them pricing upwards. Lenders are going to be much more kind of hawkish in terms of the way that they approach this because of the volatility we've just been through. And like I say, with Trump in power and lots of kind of stuff around, particularly Rachel Reeves and her plans as well, there's still a lot of uncertainty. So I think lenders are just going to kind of wait for the dust to settle first of all, and then come back to this maybe in the next week or two. Okay, now if you're a massive dweeb like me and you love reading statistics and reports about what's going on in the market, and when I say the market that touches us as property investors, I'm not just talking about the property market, although obviously that's really relevant. What we're talking about here is things that are going on in the economy as well. And so I've just compiled a series of statistics that I found really interesting. May come in useful if you're going to a pub quiz at the weekend. It can make interesting dinner party conversation, or maybe you just kind of find this stuff interesting just like me. If you don't, just feel free to skip to the next segment where I'm going to be talking about semi-commercial property. So first of all, and probably one of my favourites, so in the week 2 of January, there were 33,700 listings of properties for sale, which is 19% higher than last year and 18% higher than 2017 to 2019. We tend to skip the bit in the middle of those 19 to 21, 22, because those were the COVID years. They were just weird. So any data there is kind of a bit of an outlier, really. So not necessarily something to kind of measure against. But what we kind of can draw from that is actually there is loads and loads of properties for sale at the moment. So if you are thinking about buying, actually one of the complaints we've heard from landlords over the last few years, I want to invest, but there is just nothing to buy. And when I go and try and buy something, there's like absolutely, you know, gazillions of people all trying to bid into it, and it's just kind of going crazy. The worm has really turned here. There's lots of property for sale. You can go out and get negotiating. Now, having said that, sales are actually doing really, really well. So there were 23,800 sales agreed last week, which is 48% higher than the start of 2024 and 8.7% higher than 2017 and 2019. Now, what we can draw from that is obviously 2024 probably was a bit of a nightmare start to the year, but actually still at the sales markets, people are buying properties and there's lots of stock available. So the property market is kind of really loosening up. Now, in terms of sale fall-throughs, and this is kind of an important one, fall-throughs are stuck at 25.4%, which is kind of very close to the 7-year average, which is just under 1 in 4 sales. So 1 in 4 sales is the average over the last 7 years fall through, and we're sitting at that kind of level at the moment. So actually, in terms of performance, while the market is really picking up, lots of stock available, lots of people buying properties, and the number of fall-throughs are still kind of staying at an average level, which is really, really encouraging. Because if there was lots of transactions going through, but they're all falling over, then actually you would argue it's not worth buying something in the first place. Now, just to look at pay a little bit, so real terms pay growth is at 2.5%, and that's when you adjust it for CPIH, which is higher than CPI, by the way, and by about 1%, and that is a really great rate of real wage growth. However, it's also unsustainable in an economy that isn't actually growing. So wage growth is growing at a really kind of great level. It's ahead of the game in terms of inflation. This is great, we're all going to feel richer, but actually just keep in mind, it can't keep on at this level if the economy isn't growing. Job vacancies. So vacancies are down. There are now only 16,000 more vacancies or job vacancies than there were before the pandemic. So what this tells us is that actually the number of employers looking to recruit people has really started to slow. Vacancies are down 24,000 in Q4 2024. So another quarter like this, and actually we'd have less vacancies, job vacancies around than there were pre-pandemic. So what this can tell us is that actually in terms of recruitment, companies are really starting to slow down their recruitment decisions. Companies are starting to feel a bit of pressure. Obviously, we have the national insurance hike, which a lot of companies are absorbing, but that means that leaves them less money for growth. And actually, there's a lot of nervousness as well. Interestingly, there are now 1.9 unemployed people per vacancy. It was nearly at one person per one unemployed per vacancy, at one point. In the US, for those of you who care, there was only half a person per job vacancy at one point intra-pandemic. So what we can see here is actually there are more unemployed people per job vacancy than there has been, which tells us that actually unemployment essentially would be increasing. Now, in terms of interest rates, and this is an interesting one, and this is just a quote that I saw, which I found really kind of thought-provoking. I'm not saying it's a prediction, but it's definitely thought-provoking. And this is from Chris Williamson, who is the Chief Business Economist at Standard & Poor's Global Market Intelligence. And what he has gone on to say is essentially that inflation pressures have been reignited, pointing to stagflation, alongside job cuts and concerns about business prospects. And that's kind of echoing back to what we were just talking about with regards to the employment market. The economy is broadly flatlining. Risks are turned to the downside, so optimism is starting to fail, and there is sharp job cutting. So really kind of just underpinning all of those statistics that we have just shared. He went on to say that the Bank of England has a tough job. Rate cutting is needed to stimulate growth because the economy is really sort of flatlining, but rise in price pressures indicate that the inflation genie is by no means back in its bottle. So I think the reason I really wanted to share that with you is that because of the news about inflation coming down last month, there's been lots of headlines. MPC has to cut base rate in February, and there is a really strong chance they will, but it is not that simple because they're trying to kind of look beyond inflation, look at what's going on in the markets, and really kind of having to make a tough call about whether now is the right time indeed to bring down base rate, or whether actually that's going to be an inflationary thing, because actually inflation, while it's come down, it's by no means, we're not out of the woods with that by any stretch of the imagination. Okay, now Hampton's published a report recently which came out with a really nice headline, which is saying that under 45s are now paying £56.2 billion in rent, which, as you imagine, the press would have loved, because that's essentially saying that the young people are getting absolutely hammered in terms of rental income. But actually, I think we just need to think about this, because this is quite an interesting set of data for you as well. For most of the past decade, private rental sector growth has been from older renters who didn't purchase properties in their 20s and 30s. So according to the English Housing Survey, they draw the conclusion that renters aged 45 plus went from 1.43 million to 1.7 million, or by 24%. So actually the number of households under 45 fell by 1%. So again, adjusting for population, it actually fell, population growth, sorry, it's actually fallen by much more than that. So what we can see here is that actually, yes, indeed, the private rental sector does have lots and lots of under 45s paying a large amount of rent, but actually it's not including the fact that there's a lot of people over 45 as well who simply haven't bought house properties when they were younger. So I think that with these reports, always you get these headline information, people kind of gasp, and then actually, you know, knowing the data behind that is really worth knowing. And lastly, just to touch on rents. So this has come from a report which is from Rightmove. Again, you guys who are watching this stuff may have seen it. Rental prices outside of London fell quarter on quarter at the end of 24 for the first time since the end of 2019. The average advertised rent of properties beyond the capital fell by 0.2% to 1,341 between the third and fourth quarter of 2024. In London, the data showed a 0.1% increase in rental prices to £2,695, which is the lowest rise since early 2021. Rightmove have commented that one of the drivers of slowing rental growth has been the gradual improvement in the supply of properties. The number of available homes for rent was 13% higher than the same period last year, and the number of prospective tenants contacting letting agents about a move was 16% lower. So essentially, I think what we can see is that really large churn that we had post-COVID has really started to slow down. I do not believe there is anything to start kind of worrying about. I think actually the letting market is in really good shape. All the predictions for this year are certainly expecting rental growth to be around 4 or 5%. So I don't think we need to be kind of panicking. But what we can certainly see is that those very high levels of rental growth that we've seen over the last few years and we've benefited from as property investors are going to really start to slow down and things are starting to settle. Okay, now we are getting lots of people asking about semi-commercial properties at the moment. Why is that? Well, I think there's lots of reasons. People are looking to diversify their portfolios. They're thinking about the possibility of ultimately being able to convert the commercial parts into residential, probably under permitted development. Also, there's a stamp duty angle here. So the stamp duty you pay on a semi-commercial property is lower than if you're buying a full residential property. Also, some people like the idea of having a commercial tenant. As some of you would probably know, commercial leases tend to be much longer than your ASTs, and particularly given what's coming in with the Renters' Rights Bill. So actually people are thinking, you know, if I can get a good quality commercial tenant in a property, I can just hand the property over. The lease would be what we call FRI, so fully repairing and insuring, which means actually the tenant takes the property on, they look after it, you haven't got to do any repairs and maintenance to the insides of the building, and then once their lease is finished, they have to hand it back to you, having sort of undergone what's called a dilapidation clause, so bringing it back to how they got it in the first place. So actually, in terms of kind of ongoing day-to-day costs and management, you really shouldn't have to get involved. And some people really like the idea of that. I think it's going to really depend on how good your commercial tenant is. So a lot of people will go into commercial letting, but only if the tenant they're taking on in the commercial parts is relatively strong. So if semi-commercial is something you are thinking about, but you're wondering about the financing of it, here's some kind of headline information. So first of all, in terms of loan to value, so how much can you actually borrow? Just like buy-to-lets, up to 75%. Again, there's always going to be a rental calculation. So it's a bit like doing a buy-to-let for a semi-commercial property. How much rent is coming in? Is this going to be enough to cover the mortgage interest costs plus a bit on top for, you know, ongoing maintenance and voids and all that kind of stuff that we need to factor in tax. So yeah, 75% loan to value would be your top level on semi-commercial. And actually, because semi-commercial does tend to attract a higher yield than full residential, you will find that actually the rental calculations do tend to work. Now, in terms of rates, they are more toppy than your standard buy-to-let, understandably so. It's a commercial transaction. So I would say that actually, in terms of rates, probably add on circa 1 to 1.5% in addition to a vanilla buy-to-let rate. It's hard to do this exactly because it depends on lots of kind of peculiarities around your situation and the property itself. But I think 1 to 1.5% is probably realistic. Now, in terms of the actual mortgage you would need, so just to be clear here, as soon as you have a commercial element to the building, it becomes a sort of commercial mortgage. Now, there are some buy-to-let lenders who sort of dabble with semi-commercial properties. But by and large, if there's a commercial element to the property, it's going to be a commercial mortgage, and it's going to be a commercial mortgage for a semi-commercial property. I know the terminology can be really, really confusing. Now, in terms of experience, do you have to be experienced in letting commercial property to get a semi-commercial mortgage? No, you don't. Do you have to have experience of letting property? Probably yes. Not necessarily, but ideally. So I don't think a first-time investor would take on a semi-commercial property. Lenders generally would probably look for a little bit of experience, not loads, but just some experience of letting property in the past. Now, in terms of lease lengths, one of the questions we get asked is, I'm going to buy a property and the commercial lease, so the residential part of the building you can just broadly treat as a buy-to-let, so it would be a 6-month tenancy, that just kind of is quite normal. But for the commercial element of the building, how long does the lease length with the commercial tenant need to be? Now, in the ideal world, it would be 20 years with no break clauses. But actually, the reality is that most properties don't come with that kind of lease. And actually, there are lenders who are very happy to lend with the lease is actually relatively short, so 1 or 2 years remaining. So there's no kind of set answer to this. What I would say is that the properties tend to need to be self-financing from day one. So what lenders don't like doing is lending on a property where it's empty. They want the property to be income generating from day one. So if you're buying a property and there's no commercial tenant in it at that moment in time, but you've got someone lined up and ready to move in on day one of completion, that's okay. But if the property is going to be sat empty, you will find that more challenging to finance. Now, in terms of ownership types, you can buy a semi-commercial property in your own name using a limited company, trading or SPVs, that's no problem at all. Because the kinds of lenders who lend on semi-commercial and commercial properties are the commercial lenders, these guys are much more open to trading companies and companies with slightly more unusual structures, let's just say. So actually the kind of ownership type is something that is very, very kind of flexible. Now, lastly, just to reiterate, the lender is going to apply rental calculations in the same way that they do for buy-to-lets. And the rental calculation would be, just like a buy-to-let, an assumed interest rate that you're going to be paying, and then a calculation asking for a margin above that. So, for example, 140% coverage, assuming an interest rate of 6% or something along those lines, but there will be a rental calculation. So I hope that kind of gives you a broad overview of semi-commercial property mortgages. Like I say, we do lots of these. They're becoming very, very popular. So if you did want to give us a shout and have a chat about one of those, we'd love to hear from you. Just to remind you, the number 0345 345 6788. We've also got some really interesting case studies on our website, and also some articles around things like stamp duty on semi-commercial and why you'd want to buy one, all that kind of stuff. So lots and lots of information there, because like I say, we do a lot of these. And there you go, that's everything for me this week. Thank you, as always, for joining us. I hope you found that interesting. If there's anything you want us to cover off in future episodes, don't be shy, just ask. We don't mind, honestly, very happy to chat about whatever is of interest to you. Ultimately, this video is really here for you guys, so the more we can be talking about that's relevant to you and the stuff you're thinking about, the better. Also, I have had a question in from one of our watchers with regards to valuations post Renters' Rights Bill. I am working on this, just to say I've actually sent this out to a number of lenders and surveyors to get their thoughts, so I'll come back to you with a really informed answer rather than my own kind of guesswork. So bear with me on that one. I will be back. Have an amazing week, everybody. I hope the weekend is great. I think the weather's going to be actually not too bad. I'll probably just jinx that as well now. But hopefully, the sun will shine down, and I will see you same time next week.